What if I told you a single piece of paper signed just weeks ago could be the reason your next mortgage costs hundreds less every month? But here's the far more important and rarely asked question. If that plan backfires, who's left holding the bag? The answer might change how you view the entire housing market and your place in it. Welcome to Currency Tea. In the next 30 minutes, we're going on a deep dive. This isn't just a news recap. We're going to connect the dots between a presidential order, two strange entities with folksy names, the complex bond market, and your bank account. By the end, you'll understand the $200 billion gamble that's now in motion, the historical scars that made it possible, and the uncomfortable trade-off between short-term relief and long-term risk. This is for anyone who owns a home, wants to own a home, or simply wants to understand how powerful forces are quietly reshaping the American financial landscape. Stick with me. Let's start with the core mechanism, because everything else builds on this. It's a fundamental rule of bonds, and it's the engine of this entire plan. When demand for a bond goes up, its price rises. And when a bond's price rises, its yield, the effective interest rate it pays, goes down. They move like a seesaw, always. Now imagine a specific type of bond, a mortgage-backed security, or MBS. Think of it as a bundle of thousands of individual home loans packaged together and sold as a single investment product. When you take out a mortgage from your local bank, there's a very good chance that loan ends up inside one of these bundles. So if you want to influence the interest rate on every new mortgage in the country, what do? You become a massive, undeniable buyer of those mortgage-backed securities. You create artificial demand. The recent directive is simple in its goal. Use two government-controlled corporations to buy $200 billion worth of these MBSs. The sheer scale of that purchase is meant to push the price up, and by that same seesaw logic, pull the average mortgage rate down. The target, to break it meaningfully below the 6% range where it's been stuck, and make monthly payments more affordable. On the surface, the math is clean. The intention is clear. But to see why this is so consequential and frankly so controversial, we have to understand the tools being used. We have to meet the middlemen of the American dream, Fannie Mae and Freddie Mac. They're not banks. They're not quite government agencies. So what are they? And why does the government have the keys to their vaults? The story starts with a crisis that changed everything. Let's rewind. Fannie Mae, the Federal National Mortgage Association, was born in the Great Depression. Freddie Mac, the Federal Home Loan Mortgage Corporation, came later in 1970. Their original stated mission was noble: to provide stability, liquidity, and affordability to the U.S. housing market. They were designed as government-sponsored enterprises, or GSEs. Here's how they worked, and largely still do. You go to Wells Fargo or your local lender, they give you a mortgage, but they don't necessarily want to wait 30 years to get all their money back. So they sell your loan and millions like it to either Fannie or Freddie. These GSEs pool the loans, wrap them into those mortgage-backed securities we talked about, guarantee the payments, and sell them to investors worldwide. Pension funds, foreign governments, you name it. This process is crucial. It takes illiquid long-term loans off the bank's books and turns them into liquid tradable bonds. This gives banks fresh cash to lend out again, theoretically keeping the gears of the housing market turning smoothly. For decades, this system hummed along in the background, a mostly invisible piece of financial infrastructure. But then came 2008, the housing bubble, subprime mortgages. The entire system of assumptions collapsed. Fannie and Freddie, as massive buyers and guarantors of mortgages, were at the epicenter. When home prices crashed and defaults skyrocketed, the losses threatened to wipe them out completely. They were, for all intents and purposes, bankrupt. And in September of 2008, the unthinkable happened. The U.S. government stepped in with a historic bailout. It wasn't just a loan, it was a takeover. The government placed both companies into conservatorship under their regulator, the Federal Housing Finance Agency. This is the pivotal moment. From that day forward, the government didn't just sponsor them, it controlled them. It controls their balance sheets, it controls their profits, it controls their strategic decisions. They exist in a legal twilight. Technically, they still have private shareholders. You can even buy their stock over the counter. But let's be brutally clear. Those shareholders have virtually no power. The U.S. Treasury holds senior preferred stock and warrants for nearly 80% of the common shares. The government calls the shots. Trading that stock isn't investing in a company's earnings. It's speculating on political and legal outcomes, betting on whether or not conservatorship will ever end. This turned them from public companies into public utilities, with one primary shareholder, the American taxpayer. Which brings us to today, and the critical nuance. If the government controls them and their goal is to help housing, why is this new $200 billion bond buying plan such a big deal? Because it represents a fundamental shift in strategy. For the last 15 years, even under control, Fannie and Freddie's market activity was meant to be steady, predictable, and risk managed. They were the stable middlemen. This directive turned them into active market manipulators on a grand scale. They're being weaponized by policy to achieve a specific economic outcome: lower rates. Now, here's what makes this even more unusual. Historically, when the economy needed a jolt and mortgage rates needed to fall, the job fell to the Federal Reserve. During the Great Financial Crisis and again during the COVID pandemic, the Fed embarked on quantitative easing, buying trillions in Treasury bonds and MBSs itself. But today, the Fed is fighting inflation. Its goal is to tighten financial conditions, not loosen them. It's actively reducing its own bond holdings. It wants no part in buying more mortgage bonds. So policymakers are turning to the only other two entities with the scale and the mechanism to do it: Fannie Mae and Freddie Mac. It's a workaround, a bypass of the traditional central bank lever. This blurs lines in a profound way. Monetary policy, the Fed's job, is supposed to be independent. Fiscal policy, government spending, taxation, is Congress's domain. Housing policy sits somewhere in between. This move smudges all three together. It's using a housing finance tool to achieve a macroeconomic goal, precisely because the traditional macroeconomic tool is off the table. Now, let's address the elephant in the room, the $200 billion question. Who bears the risk? Fannie Mae and Freddie Mac are buying $200 billion in mortgage-backed securities. What if home prices fall? What if a recession hits and defaults rise? The value of those MBSs could decline. Losses could mount. And here is the uncomfortable, non-negotiable truth. Fannie and Freddie, despite years of profitability since the bailout, still operate under the protective umbrella of the U.S. Treasury. They do not have the massive private capital buffers of a truly private standalone company. If these targeted purchases lead to significant losses, those losses will likely land on the public balance sheet. The profits were privatized for years, but the risk, that remains profoundly socialized. In plain English, the potential downside is ultimately backstopped by the taxpayer, you, me, and everyone else. The government, as the controlling conservator, cannot let them fail again. So if this gamble goes south, the public absorbs the blow. This is why economists and policy experts are so divided. Supporters argue this is necessary. Housing is a social good. Affordability is a crisis. And with the Fed on the sidelines, this is the only tool left to provide relief. The ends justify the means. Critics see this as a dangerous precedent. It distorts market pricing, delays the long-needed reform of the housing finance system, and further entrenches a morally hazardous link between private profit and public risk. It's a short-term fix with potentially long-term consequences. Let's zoom out to the bigger picture this reveals. This move is a stark admission, an admission that housing affordability is seen as a politically existential issue, an admission that the traditional lever pullers are either unwilling or unable to act. It shows a willingness to use hybrid government-controlled entities as flexible tools to manage economic and political outcomes. We're moving from a world of independent economic policy to one of managed outcomes where the lines between state and market are increasingly blurred. Will it work? In the immediate term, it might. Throwing $200 billion of demand in the MBS market will likely put downward pressure on rates. We may see the 30-year fix dip below 6%. That'll create winners: home buyers on the margin, homeowners looking to refinance, the real estate industry. But does it solve the core issue of housing affordability? Unlikely. High home prices are driven by a chronic shortage of supply, zoning laws, and construction costs. Lower rates without more homes can even push prices higher by boosting demand. It treats a symptom, not the disease. And it leaves us with profound questions. What is the end game for Fannie and Freddie? Permanent wards of the state? What happens in the next crisis? Does this set a template for intervening in other sensitive markets? We're writing a new chapter in the rulebook, and we don't yet know how this story ends. Let's recap the journey. A directive aims to lower mortgage rates by ordering two government-controlled corporations to buy $200 billion in mortgage bonds. This works through the basic seesaw of bond prices and yields.
The tools for this job, Fannie and Freddie, exist in their current powerful yet captive form because of the 2008 bailout, a crisis that made them permanent instruments of government policy. This move is unusual because it bypasses the Federal Reserve, merging housing, fiscal, and monetary policy in a novel way. The most critical takeaway: the quest for lower monthly payments relies on a mechanism where the potential financial risk is ultimately borne by the public. It's a deliberate trade-off. The Winds of Thought is about seeing the connections. It's not just a news headline about mortgage rates. It's a story about crisis